For a long time, the narrative surrounding the Schwab U.S. Dividend Equity ETF, SCHD, was one of quiet decline. Investors spent 3 years watching this fund underperform compared to the meteoric rise of growth-heavy indices. The prevailing wisdom was simple. Abandon the boring dividend strategy, buy the S&P 500 VOO, and stop worrying about quarterly payouts. Comment sections across financial platforms were filled with skepticism, painting SCHD as a relic of a bygone era. However, the financial landscape of 2026 has completely upended that narrative. As of earlier this year, SCHD has surged nearly 13%, while the broader S&P 500 has languished in negative territory. We are witnessing one of the most significant performance gaps between dividend value and growth in recent memory, with SCHD outperforming the world's most popular index by a staggering margin of 16 to 20 percentage points. This shift isn't a result of luck or market sentiment alone. It is the culmination of structural changes in the global economy. I am personally allocating an additional $10,000 to SCHD this month. This isn't a decision driven by hype or a gut feeling. It is a decision driven by cold, hard mathematics. In this analysis, we will explore the mechanics behind this massive comeback, examine the automated reconstitution move that positioned the fund for success, and break down exactly what these numbers mean for your long-term wealth. The 2026 Market Divergence. Numbers on the table. To understand the magnitude of this shift, we have to look at the data. By the end of the first quarter of 2026, SCHD delivered a 12.79% total return. In contrast, the S&P 500, tracked by SPY, has struggled, sitting down between 4% and 7%, depending on your specific tracking metrics. When an $85.9 billion fund beats the primary market benchmark by 20 points in just 3 months, it isn't just a good quarter. It's a tectonic shift in capital allocation. 3 primary forces have converged to create this environment. The first is what analysts are calling the Great Rotation. For years, capital was concentrated in mega-cap tech stocks, driven by the promise of artificial intelligence. However, in 2026, the market hit a wall. Investors began to realize that paying 27 times earnings for companies whose AI investments have yet to produce tangible, massive returns is a risky proposition. Consequently, money is flowing out of overvalued growth stocks and into high-quality value and dividend-paying equities. The second force is geopolitical instability. On February 28, 2026, the escalation of conflict involving Iran sent shockwaves through the energy sector. Brent crude oil spiked to $118 a barrel, the highest level since 2022, amid fears of a blockade in the Strait of Hormuz, a vital artery for 20% of the world's oil supply. While the S&P 500 dropped nearly 9% and flirted with correction territory, SCHD's defensive posture allowed it to weather the storm, pulling back only about 3%. Its heavy exposure to energy, consumer staples, and healthcare acted as a stabilizer. Finally, the interest rate environment has shifted. The 10-year Treasury yield dropped from 4.58% to approximately 4.09%. As rates fall, the fixed income yield of bonds becomes less competitive compared to the growing dividends of high-quality stocks. This creates a natural tailwind for funds like SCHD, making their 3% plus yields far more attractive to income-seeking investors. The robot investor. SCHD's cold-blooded reconstitution. Perhaps the most fascinating aspect of SCHD's 2026 performance is how it achieved these gains. Unlike actively managed funds, where human emotions like ego, fear, and attachment influence decisions, SCHD operates on a strict, rules-based algorithm. On March 23, 2026, the algorithm executed one of the most aggressive overhauls in the fund's history, removing 22 stocks and adding 25 new ones. The sell side of this move was purely mathematical. It looked at massive winners like Valero, up 80%, and Halliburton, up 46.5%, and sold them. While a human investor might have held on, hoping for more gains, the algorithm recognized that these stocks had exceeded their value metrics. It locked in the profits and moved on without a second thought. With the proceeds from those sales, the algorithm did something bold. In early 2026, United Health Group, UNH, the world's largest private health insurer, saw its stock plummet nearly 50% from all-time highs. The reasons were numerous. The first projected revenue decline in 30 years, a Department of Justice antitrust investigation, and rising medical care costs. To the average investor, UNH looked uninvestable. But SCHD's algorithm saw a blue-chip giant trading at 16 times forward earnings, well below its historical average of 19 times, that still met all quality screens. The fund didn't just nibble. It bought UNH at the maximum 4% weighting, making it a top 10 holding. This is the definition of buying the blood in the streets. If UNH recovers even partially toward analyst price targets, it could contribute significantly to SCHD's total return for the year. Quality upgrades and the accidental market timing. The March 2026 reshuffle didn't just target healthcare. The fund also picked up major players like Blackstone, Accenture, and Ares Management at significant discounts, all companies with robust balance sheets that the market had temporarily abandoned. Crucially, the quality of the fund's dividends improved during this process. The incoming stocks had an average 5-year dividend growth rate of 63%, while the outgoing stocks averaged only 37%. This means the fund didn't just buy cheaper stocks. It bought stocks that are growing their payouts at a much faster clip. Furthermore, SCHD demonstrated an almost uncanny ability to time the energy market. By entering 2026 with a 23.9% weighting in energy, the fund was perfectly positioned to profit from the oil price spike caused by the Iran conflict. After energy stocks soared, the March reconstitution automatically trimmed that weighting back down to about 15%, effectively selling at the high and rotating that money into beaten-down sectors like healthcare and finance. It's a level of precision that human managers rarely achieve. Following the smart money, inflows, and valuations, if you want to know where the market is going, watch the movement of capital. In a single week in February 2026, while the S&P 500, SPY, saw an exodus of $16.1 billion, SCHD enjoyed net inflows of nearly $800 million. Over the last 3 months, over $4.7 billion has poured into this ETF. Despite its recent run, SCHD remains remarkably affordable. Price to earnings, PE ratio. SCHD sits at roughly 18 times to 19 times, while the S&P 500 remains bloated at 23 times to 27 times. Dividend yield. You are getting roughly 3.4% with SCHD, nearly triple the 1.17% offered by the S&P 500. Volatility. With a 5-year beta of 0.65, SCHD is about 35% less volatile than the broader market. In essence, you are buying a more stable, higher-yielding product at a 30% discount compared to the standard index. The power of passive income. A $10,000 example. Let's contextualize what a $10,000 investment looks like at a share price of roughly $30.56. This purchase nets you approximately 327 shares, which would generate about $347 in annual dividends. While $347 a year doesn't lead to early retirement immediately, it effectively covers your recurring lifestyle costs, like streaming services or a gym membership, without you having to work a single extra hour. The true magic, however, lies in the compounding effect. SCHD has grown its dividend by an average of over 10% annually over the last decade. If you hold that $10,000 investment for 10 years, and the growth rate continues, your annual payout could reach nearly $940. If you had invested $10,000 at the fund's inception in 2011, your position would be worth over $58,000 today. This is the yield on cost advantage. Investors who bought years ago are now seeing a 6% or higher yield on their original principal. Addressing the risks. A balanced perspective. No investment is without its pitfalls, and it is vital to acknowledge the risks facing SCHD in the latter half of 2026. Energy sensitivity. Even after trimming, the fund still has a significant energy stake. If geopolitical tensions ease and oil drops back to $70, the fund will face headwinds. Growth resurgence. If the tech sector finds its footing and the AI narrative regains its momentum, value funds like SCHD could return to a period of underperformance. Specific stock risks. The massive bet on United Health Group carries risk. If the DOJ investigation leads to severe penalties or structural changes, it will weigh on the fund's performance. The crowded trade. With assets under management hitting $85.9 billion, there is a risk that the trade is becoming too popular, which can lead to distorted pricing and heightened volatility during market sell-offs. Conclusion. The math wins. When we weigh the risks against the current opportunity, the conclusion remains firm. The 20-point outperformance gap we are seeing isn't a fluke, it's a structural correction. SCHD offers nearly 3 times the yield of the S&P 500 at a significant valuation discount, all while maintaining lower fees and lower volatility. The robot investor has successfully upgraded the portfolio, selling high and buying the crashes that others were too afraid to touch. This systematic, emotionless approach is exactly why SCHD remains a cornerstone of a rational investment strategy. The question for you: if you were given $10,000 today and had to lock it away in one ETF for the next decade, Would you choose the dividend growth of SCHD or the broad market exposure of VOO? The math points in one direction, but the choice, as always, is yours.